This dashboard highlights our current macro read. We are operating in a risk-on reflation regime, supported by a risk bias score of 7. The immediate data suggests investors should remain fully invested through the summer months to capture the current expansion. However, the probability of a meaningful correction increases as we move into the September through December window, which aligns with a historically weaker seasonal period for risk assets. Trusting this systematic timeline allows you to hold profitable positions today without feeling the need to overreact to daily news cycles. Many investors remain concerned about a hawkish Federal Reserve and U.S. CPI hitting 4.2% year-over-year in May. But looking at the drivers, the Iran conflict temporarily pushed WTI crude oil above $100 per barrel, accounting for much of that inflation spike. Diplomatic progress has since helped crude oil retreat below $80, removing the primary upside inflation risk. As commodity-related pressures fade, the immediate threat of a sustained inflation-driven risk-off regime is also moderating. The underlying growth data confirms this resilience. U.S. retail sales recently surprised with a 0.9% month-over-month increase, showing that consumer demand remains strong despite higher borrowing costs. Corporate earnings expectations also continue to rise, driven by heavy investment in artificial intelligence, infrastructure spending, and a healthy labor market. Furthermore, global liquidity is providing a steady tailwind. Central banks have slowed the pace of quantitative tightening, while fiscal deficits continue to inject fresh capital into the private sector. This combination of resilient growth and expanding money supply supports the S&P 500 remaining near its record highs around the 7,500 area. Capital positioning also appears healthy throughout recent geopolitical uncertainty. Institutional investors have consistently stepped in to buy market weakness rather than reducing risk. Crucially, market participation is expanding. The rally is no longer confined to a handful of mega-cap technology companies, creating a more stable foundation for risk assets. This broad institutional support provides a structural floor for the market, making it safe to stay invested through the rest of the summer. To capitalize on this reflation regime, our positioning favors cyclical equities, financials, industrials, technology, alongside small caps and high-yield credit. However, watch the calendar. We expect leading indicators to deteriorate entering the weak autumn window, increasing market vulnerability. By following a systematic framework, you can maintain these profitable cyclical exposures now, while preparing to shift toward defensive positioning before the broader market fully appreciates the turn in the cycle.